Welcome to the award-winning Consumer Finance Monitor podcast, where we explore important new developments in the world of consumer financial services and what they mean for your business, your customers, and the industry. This is a weekly show brought to you by the Consumer Financial Services Group at the Ballard Spahr Law Firm. And I'm your host, Alan Kaplinsky, the founder and former practice group leader for 25 years and now senior counsel of the Consumer Financial Services Group at Ballard Spahr. And I'm very pleased to be moderating today's show. For those of you who want even more information about the topic that we'll be talking about today, or for that matter, anything else in the world of consumer finance, don't forget our blog that goes by under the name of Consumer Finance Monitor. That is the very same name as our podcast show. We've hosted our blog since July 21, 2011, when the CFPB became operational. So there's a lot of relevant industry content there. Indeed, at one time, when we launched our blog, we were called CFPB Monitor. But then with the first Trump administration, we were concerned that there wouldn't be a lot going on, and we broadened the scope of the content that we covered, and we changed our name. We also regularly host webinars on subjects of interest to those in the industry. So to subscribe to our blog or to get on the list for our webinars, please visit us at ballardspar.com. And if you like our podcast, please let us know about it. You can leave us a review on Apple Podcasts, YouTube, Spotify, or whatever platform you may use. Also, please let us know if you have any ideas for another topic that we should consider covering or speakers that we should consider inviting as guests on our show. So today, we're going to be discussing a thought-provoking article titled Tearing Holes in Consumer Protection, Democracy's Safety Net. I'm going to introduce our speaker in just a moment, but before I do that, let me just tell you a little bit about this article. The article advances what I consider to be a very bold thesis, that consumer protection law, and particularly consumer financial protection, may be the most impactful body of law in the United States. It also suggests that the strength of consumer protection laws may serve as a barometer for the health of American democracy. The article focuses in significant part on the role of the Consumer Financial Protection Bureau, created by the Dodd-Frank Act, and examines how changes in regulatory priorities may affect both consumers and the broader financial system. Before we begin, I want to note this podcast is intended to provide a forum for thoughtful discussions. The views expressed by our guest, who I will introduce in a moment, are her own. That's not to say that they're not shared by a lot of other people. But my goal today is not just to explore those views, but also, where appropriate, to test them where I think there may be a basis for doing so. Well, without further ado, let me introduce our very special guest. Her name is Amelia O'Rourke-Owens. Amelia is a legal scholar whose work focuses on consumer protection, financial regulation, and the intersection between economic policy and democratic governance. Her research explores how legal frameworks shape consumer financial markets and how regulatory institutions influence the balance between consumer protection and industry concerns. Amelia received her law degree at North Central University Law School a place where Amelia now teaches a course. Amelia has worked in community economic development, consumer protection, and programmatic implementation. I guess the unifying thread in Amelia's career, and I took this from the website of her company, which I'm about to mention, is maximizing impact with minimal resources. And that, I guess, is another way of saying with great efficiency. Amelia is the founder and CEO of Resilience Solutions, which provides subject matter expertise and consulting services around policy solutions and strategic planning. The services enhance strategic objectives of their clients and build resilience in their enterprise and efforts. They have a background in legal services. Obviously, Amelia is a lawyer, nonprofit management, and government policy positions. They help clients with long-term strategic planning to substantive policy visioning to wrap around legal logistics. Amelia was also, prior to founding Resilience Solutions, was a policy fellow at the CFPB for a little more than 3 years, from January 2022 through February 2025, a period of time when Rohit Chopra was the director. So a very warm welcome to you, Amelia.
Thank you, Alan. Thanks for having me.
My pleasure. Well, I have a lot of questions for you today. So, Amelia, let's start with the core thesis of your article. You argue that the consumer protection law may be the most impactful body of law in the U.S. Can you walk us through the framework you use to evaluate the impact of different areas of law?
Sure. Thank you so much, Alan. So, what I've ultimately proposed is a qualitative analysis that considers three prongs in evaluating kind of the level of impact of a law or body of laws. And those three prongs are first, the number of individuals protected, second, what I call entities governed, and then third, the avenues for enforcement. And the point of this qualitative framework is that measuring impact allows both a retrospective and a prospective analysis. And so to kind of drill down into what we're looking at in these three criteria are with number of individuals protected, we're kind of asking broadly, how can individuals avail themselves of these protections, or from whom are they protected, or how broadly or narrowly construed is the class of those protected under the law? Second, what I call entities governed is the breadth of actors that are governed by that law. How specific or broad can the behaviors be to pull them under that umbrella? But also under this category, I include some analysis or inclusion of whether certain entities, all entities, and what category of those are pulled under supervisory and or regulatory powers. And then finally, under avenues for enforcement, we're really looking at the expansiveness of opportunities for enforcement, or of course, the other side being the constriction of that.
Okay. So, Amelia, that is a thoughtful framework, particularly how directly consumer protection law touches many individuals' day-to-day lives. But it's quantitative in nature. And I want to push back a little bit because I think you have to consider the qualitative aspect of what the particular agency or agencies are doing. And that impact can be measured in terms of economic consequences and systemic effects. And one concern that I've seen, especially during the tenure of former CFPB Director Rohit Chopra, is that an expansive view of impact can justify increasingly aggressive regulatory interventions. For example, The CFPB under Chopra pursued novel theories under its UDAP authority, unfair, deceptive, and abusive acts and practices, such as encompassing within UDAP discrimination, a type of discrimination broader than the Equal Credit Opportunity Act, attempts to regulate so-called junk fees across a wide range of products, sometimes without clear statutory grounding. Similarly, broad reinterpretations of discrimination under UDAP to include disparate impact raised serious concerns about whether the Bureau was effectively legislating rather than enforcing. So while I appreciate your framework, I wonder whether it risks giving regulators too much latitude to define impact in ways that expand their own authority. Just, my 2 cents, I guess you could say. Let's drill down a bit into how this plays out in practice. You focus very heavily on consumer financial protection laws and institutions. What, in your view, distinguishes consumer financial protection from other areas of law that also have very broad societal impacts, such as environmental laws, which probably has a wider impact? Consumer finance is sort of one category of consumer protection, but it's just one piece of it. You've got environmental laws, securities laws, I'm drawing a blank on the name of the federal agency that deals with safety for toys. I forgot what that's called. You could probably help me out on that.
Child Product Safety Commission.
And you've got a lot of other agencies that also have a large impact. So why consumer financial protection? Other than what you've already said, it affects a lot of people in a quantitative way.
Qualitative.
Oh, qualitative. Okay.
Yes. I would certainly not go so far as to try to argue that.
I guess it's both but quantitative and qualitative. It's really what you're saying, because you focused on the number of individuals protected, the number of entities that are governed, and the avenues for seeking relief. But anyway, yeah. So why is it more important, let's say, than environmental law?
Sure. I don't think it's more important. And I think also this question really underscores the value of this analytical framework, because while it may be true, for example, that the number of individuals impacted under another body of law may be more expansive, the number may be larger, I think that what this really underscores is that there are other laws that affect maybe as many or even more individuals, but because the entities governed is substantially curtailed by the legislation or the avenues for enforcement are structurally deficient, it's this combined framework, these combined prongs that make consumer financial protection the most impactful. And so I think what distinguishes, for example, financial protection law from, as you pointed to, environmental regulations or health law, this is really where these bodies of law stand in contrast under the framework. That environmental law is pretty curtailed by both the entities governed and also by the avenues for enforcement.
Right. That distinction makes sense, especially your point about immediacy and the scale of consumer financial transactions. But again, and I don't mean to be a broken record, I think there's another side to the story. The financial products are highly sensitive to regulatory uncertainty. And during Chopra's tenure, we saw a lot of efforts to reshape entire markets. I'm thinking of new products, fintech products like buy now, pay later, earned wage access, overdraft services that banks provide, even credit card late fees, often through a mix of enforcement guidance and public pressure, rather than clear rulemaking. So from an industry's perspective, that kind of approach can create unpredictability, which ultimately can reduce access to credit or increase costs for consumers, the very people the Bureau is trying to protect. So I guess what I'm saying is it all depends on who's in charge, I think. And unfortunately, with the CFPB, and I'm not trying to be political here because I also am very much opposed to the way the CFPB is being managed under acting director Vogt. That's just the antithesis of how it should be done. Politics needs to be taken out of it, and both sides, whether Democrats or Republicans, have to try to enforce the law even-handedly, interpret the statutes as written. Don't push the envelope in either direction. Don't take a narrower interpretation than the statute allows, and don't go into an area that's not contemplated by the language in a statute. So I think, I guess if I had a critique of your article, I would say it would be that a lot depends on who's in charge. And with the right people in charge, yeah, I get a lot closer to agreement with you.
Well, first of all, I would say that, acting director Russell Vogt terminated me without notice in February of 2025. And then after I was reinstated by court order, gave me a reduction in force notice in April of 2025. So I would agree that there is some uncertainty in the way that the CFPB is being run that I personally have experienced. But you said that financial services is extremely sensitive to regulatory uncertainty. And I would argue that financial services is also extremely sensitive to a lack of regulatory authority. And I think WAMU stands to reason. That is a great example par excellence that without consistent and predictable regulatory authority, it's not as though industry is going to be smooth sailing or self-regulating. And so this notion, I just think that I would also push back on you a little bit that there's sensitivity, there's the economic impacts that you alluded to at the beginning of this podcast, but then there's also just distaste. And I don't think it's wrong for the financial services industry to say we don't like this, but does that mean that it's actually bad? I think that those are two different questions. And so I would just push back a little bit on the notion that this regulatory Director Chopra's, CFPB was somehow or other creating volatility for the financial services industry when we've seen the extreme volatility that no regulatory efforts can also lead to.
Okay, point well taken. You emphasize that consumer financial protection law benefits from multiple avenues of enforcement, federal agencies, state agencies, like state attorneys general, and private litigation. How important is it to you that is that combination of enforcement players in making these laws effective? Is that critical?
I think so, absolutely. I mean, first of all, I think I will say that when I first kind of started researching this framework and trying to create a shared analysis for impacts of bodies of law, I didn't have private right of action under the avenues for enforcement. But I think that, first of all, kind of looking at some state level examples where, for example, small dollar consumer claims no longer allow for attorney's fees for the victor has really shut a lot of consumers out of what some may consider a small dollar claim, but for example, a senior on fixed income may actually be kind of a make or break amount of money. And so I think for private right of action, that's something that I really kind of came around to in the research as understanding as an important factor, but not determinative. And I say that too, again, because as I alluded to with the Florida example, a lot of individuals simply cannot avail themselves of a private attorney. They can't afford it, or they live in communities where they don't have adequate access to attorneys who bring these kinds of claims. But for state attorneys general, I think that that is hugely important. And in the paper, I also allude to the value of Dodd-Frank and being so explicit on preemption. And state attorneys general sometimes have a local trend that's harmful to consumers that may be popping up before it's become a national problem. It may be hyper-localized, it may be exploiting local laws, or it could just be something that an attorney general who is really responsive to their constituents has their finger on the pulse of an emerging problem before other people. And I think that we saw during 2008 that questions of preemption are frankly a distraction from how we're protecting consumers and individuals and frankly their financial lives. And so what Dodd-Frank did was it sidestepped that entire administrative question, and it said, state laws are not preempted by these federal financial protection laws so long as they offer more protection to the consumers. And I think that that was a really elegant strategy to kind of make sure that we're preserving these multiple avenues for enforcement. Because, as I highlight historically in the paper, during the 2008 financial crisis, some state attorneys general were trying to act earlier, and they were explicitly stopped by some of these kind of preemption debates.
So, in my view, Amelia, the test for National Bank Act preemption is whether or not the state law significantly impairs a power of a national bank. It's not whether the state law is more protective than the federal law. But let me mention something that may actually support your argument about the need for state attorneys general and other state agencies to get more involved, not just because of the void created by the CFPB's lack of action during the Trump administration, but also because of the fact that arbitration provisions are extremely common in almost all consumer contracts, particularly online contracts. And those arbitration provisions contain class action waivers that prohibit the individual from maintaining a class action. So there is, still a fair amount of private litigation, but not as much, I think, as there used to be as a result of arbitration. But once again, I think there's another side to the story, and this is where the industry has a problem. And that is that financial products are also highly sensitive to regulatory uncertainty. And that if there is over enforcement and it creates inconsistencies between how the federal government is interpreting something and how the state is interpreting something, particularly if it's an issue of federal law, then it does really stymie companies who want to do the right thing but aren't sure what version of the law they need to comply with or what interpretation they need to comply with. That layering can create a situation where an institution is facing overlapping, sometimes conflicting expectations. And when you add in the CFPB's willingness to push the envelope in enforcement, and there are many situations during Rohit Chopra's term where I feel he did that, it can feel less like a coordinated system and more like a patchwork of moving targets, I guess is the best way I can describe it.
Well, I mean, again, I think that the sensitivity here, I would point out is different than distaste. And I think it's fine for industry to say, hey, this is onerous, or this is burdensome, or we just don't like allocating our resources in this way. But preemption was also a problem, but it cut in favor of industry during 2008. And no one was, arguing that created a confusing patchwork of inconsistency for industry then. So I think that what I'm just trying to underscore here is that the notion that businesses are subject to, enforcement and regulation, and in some cases supervision, doesn't mean that it's unfair or inconsistent or creating a patchwork. It maybe means it's onerous. And I think that it's important for us to be specific in what those frustrations versus harms are.
Well, what happens is, and this is what used to happen during the Roe-Chopra era, it's not happening right now, of course, because there's not a lot going on at the CFPB, but clients would come to me and say they'd have a new idea for a new product or a new service. They'd be very excited. They would describe it to me, and they'd wait with bated breath while I answered their question of whether or not this could legally be offered in the way that they desire. And I would too often have to say, it's my view, it's in full compliance with federal law, it's in full compliance with state law, but Rohit Chopra, if we were to go to the CFPB to describe what you're going to do, they won't like it, and they'll think of a way of going after you. So you would have to be prepared to face an enforcement action, and that can cost a bundle of money. That's not right. There shouldn't be, that. It shouldn't be that. And part of the problem with the CFPB is that it's one individual. It's just one individual who is deciding policy, who's interpreting the law. And that, when it comes to consumer finance, that person is more powerful than the president of the United States. So that's the problem that I'm having.
Well, that person is appointed by the president of the United States, right?
Of course, and can be removed. But you don't see Trump trying to remove vote, and you didn't see Biden trying to remove Rohit Chopra. That person is in there, for the duration of the presidency. And let's turn specifically to the CFPB, because I think we can all agree, at least until what's happened under Trump 2.0, that's the most significant consumer finance regulator. I grant you that the banking agencies get involved to some extent. The Federal Trade Commission gets involved, particularly with non-banks, not with banks. What do you see as the significant accomplishments of the Bureau? And I'll go back even before the Chopra term. Let's go back to the very beginning, if you want to, when it became operational on July 21, 2011.
I think by and far it's the consumer complaint portal. As, Pavi Bacon kind of describes it in her article, it's, America's consumer hotline. And the consumer complaint portal, in my mind, is the bedrock on which the rest of these consumer protections that are or were available through the CFPB are built upon. It can, first of all, demand a response from a company that is otherwise not being responsive to the client that they're serving. And also, those consumer complaints are aggregated in data that's available to the public that can inform attorneys general, researchers, academics, private attorneys. And also, it gives us a sense of, is this a one-off problem, or are we seeing a consistent pattern over time with this company of X, Y, or Z? So I think the consumer complaint portal is by and far that the most incredible development or implementation of the CFPB. And I mean, how many of us haven't screamed the word human into a phone over the last year? It is so hard to get a response from almost any company with which we interface. And that's not just financial services, but I think when we're dealing with people's money or mortgages or their lifetime savings, that we can understand how that need to have a problem solved may be felt more acutely by the individual.
Yeah, I 100% agree with you. I mean, if you were to ask me the same question, I would say the complaint portal, number one. What I would put number two is the early work during the Cordray leadership, promulgating regulations related to mortgage origination and mortgage servicing. It took a long time to do it, and it really changed things very dramatically. And I think by and large, that was a big success. And actually, I would say, sort of getting back to the earlier thing about the politicization of CFPB is a bad thing, whether it's coming from the right or the left. Richard Cordray strikes me as somebody, even though he was appointed by a Democratic president, he was a former Attorney General of Ohio, he would listen to the industry. I testified in front of him several times about consumer arbitration, and I felt, he was open to listening to both sides of an issue. Some critics of the CFPB argue that the structure and regulatory approach can create this uncertainty that we've talked about, and that can even lead to a restriction in access to credit. And that's something I assume that you don't want to happen. I mean, you don't want there to be an over-regulation to such an extent that low and moderate income individuals are being cut out of the market. And that, was the big concern with the credit card late fee proposal, the $8 late fee that they wanted to put on credit cards, that was going to lead to credit cards not being much less available to low and moderate income individuals. Well, what's your reaction to that?
Well, I think that Annalise Rawls summarizes it much better than I could, that financial protection, consumer financial protection, or financial regulation, macroeconomic stability and financial stability are two of the cornerstones that are essential there. And I think, too, what I would point out is I spent a good deal of time in writing this article, researching and going through and frankly just rereading the Financial Crisis Inquiry Report. And these arguments that, any kind of regulatory oversight limits access to credit was exactly the talking point used in testimony before Congress, in advertisements, and in press releases by industry for adjustable rate mortgages. So I think that we, again, need to separate out what is an innovation that's expanding access, and then what is just anti-oversight that is allowing for innovation without guardrails. And as I argue in the paper, that I think that this paper, frankly, takes a pretty sympathetic view of industry, which is that industry has its fiduciary duties, right? The corporations have their fiduciary duties, and it's not to the consumer. And so sometimes their short-term profit-motivated interests are at odds with consumers. And I think that in this question of how does it discourage innovation or access to credit, is it discouraging innovation, or is regulatory oversight ultimately promoting innovation, but with guardrails so that we're protecting law-following businesses and industry from those competitors who might engage in dangerous corner cutting in order to maximize their own profits? How can regulation and oversight protect companies who are trying to act responsibly, or maybe balance the needs of their customers. So I think that, I would just argue that, the argument of providing access to credit is, I think, something that is still to be solved. I would not disagree at all that we still have multi-generational poverty, that we have systemic factors that absolutely function against people's ability to access credit from forces outside of just their own personal decisions, right? Which is ultimately what a perfect credit system would evaluate. But the notion that regulatory oversight is somehow or other stifling that access feels a little bit both counterintuitive and also contra to the evidence that we have before us from what happened with ARMS and a lot of the alternative mortgage products that kind of proliferated leading up to 2008.
I agree with you that what took place during the Cordray era, the reforms that were made to the laws pertaining to mortgage origination and servicing were, I think, required. I would never try to defend what the mortgage industry was engaging, some of the things they were engaging in back then. But later, after Cordray, and I hate to be pointing the finger just at Chopra, but he's really the poster child here for me. When regulators push the envelope, as I would argue he did, particularly in the between the election in 2004 and when his term expired shortly after Trump was inaugurated, there can be a cumulative effect based on that. I mean, during that period of time, it seemed like a day didn't go by without a new regulation, a new proposal, new guidance. I mean, he just seemed to be emptying out. He knew he wasn't going to be there much longer, and he just, threw everything up against the wall to see what would stick. But it's true, institutions were more risk averse. Innovation did slow down, and credit became less available. There were a lot of people who came to me with ideas to offer special credit that would cater to the needs of low and moderate income people, and they were discouraged from doing that because of the concern about one individual. And the other thing I think that, and I can't prove this because I haven't had a conversation with Russell Vogt about it, but I think what happened during the Chopra era helps to explain the strong reaction, or maybe, and I would say overreaction, we've seen from acting director Vogt. His efforts to significantly scale back or even dismantle aspects of the CFPB didn't occur in a vacuum. They were, at least in part, a response to what many viewed as regulatory overreach during the Chopra administration. And, I would contrast that during Trump 1.0, when he appointed Kathy Kraninger as the director of the CFPB, while she had a different agenda than Richard Cordray had. She didn't do anything like what Vogt has done. There was no intent. In fact, there was actually more enforcement litigation under Kathy Kraninger than there was under Rohit Chopra. He was focused more on regulations and issuing guidance that didn't amount to regulations. It really wasn't to the very end of his term that he got very focused on issuing regulations. Let's shift, if we can, because we're running out of time, to one of the more provocative aspects of your article. You suggest that consumer financial protection can serve as a bellwether for the health of democracy. Can you explain what you mean by that and why you see that connection as being so strong?
Yeah, I think that this boils down to the government's role in elevating the interests of its own constituents. The quote that I pulled from Dodderwike back from 1948, which was discussing the Food and Drug Acts then, said that the circumstances of modern industrialism are largely beyond self-protection. And what the court is leaning on with that framing is that the government must act to protect individuals, consumers, constituents, whatever you want to call them, against businesses' short-term interests. And that no amount of an informed consumer can effectively protect against, what our modern financial services industry look like. Osita Nwanevu argues in The Right of the People that one of the pillars of an effective democracy is the government's responsiveness to people. And so the reason that I kind of I'm returning to this argument of the bellwether for American democracy is because in being so impactful, in affecting so many constituents who can be very differently situated within society, financial protection law is impactful. And this current government's antipathy towards financial protection is an elevation of an interest, and it is not that of their constituents. And so I think it really comes down to this notion, again, Nwanevu points out the three pillars of a democracy, which is that there's political equality, that there's responsiveness, and that there's majority rule. And I really wanted to kind of dig into this notion of responsiveness. And, to your point, Alan, about the regulatory uncertainty and your clients who were afraid to issue the special purpose credit or whatever their special credit extension offers were. I mean, the notion that innovation alone, or the notion that a regulatory advisor, its existence can expand or contract that access to credit, doesn't quite feel borne out by the record. We know that looking back on this century, home ownership, the Fed reduced interest rates, there was a surge of refinancing, and then there was just kind of this proliferation of home sales, new home builds, and refinancing more broadly. But we also know that home ownership reached a record high in the spring of 2004 at 69.2%, and it never budged above that. But we had this runaway, no regulatory oversight happening for at least 3 to 4 more years before the other shoe dropped. So I think that what we see when we're looking at the historical record in this country, the very near historical record, is not that a regulatory oversight is what determines that access. I would also point out that, in the years before 2008, as I alluded to before, the OCC wanted to issue non-binding guidance, but they couldn't. And the American Bankers Association and Mortgage Bankers Association both went on record as saying that that would be too onerous. So again, I think that we have I really do appreciate that in your last question, you really kind of are being more direct about, we didn't like Director Chopra. And we didn't like the way that he ran the agency. And I think that that's a fair argument for industry to make. But I think that this notion, this kind of unsupported logical jump that it's that regulatory oversight or that zealous enforcement of the law that somehow or other curtails access to credit or innovation or, harms the financial services industry is just not borne out.
Yeah. But, and I'm going to try not to be repetitive, but I tend to come back to the same or a similar theme. I'm somewhat skeptical of tying consumer financial regulation so closely to democratic health. You could just as easily argue that regulatory overreach, particularly by an independent, so-called independent agency run by one individual with limited accountability, except perhaps to the president, raises its own democratic concerns. Again, if you look at the CFPB under Chopra, critics would say the Bureau was advancing policy goals that had not been clearly authorized by Congress. From that perspective, the issue isn't too little consumer protection, it's whether the regulatory process itself remains grounded in democratic principles. I mean, that's how I look at it. But I know, we look at this a little bit differently. I've got a couple more questions before we wrap things up. Let's look ahead to the future. What do you see as the biggest challenges facing consumer financial protection? And let's say in the next 5 to 10 years. I mean, it's pretty easy to answer it by saying the biggest challenge is that the CFPB has been neutered, and it has been for sure. But what else is there? Is that really in your mind the key thing?
I mean, to me, top of mind is fraud. And I think that this is another great example of there's distaste and then there's, actual harm. And I think that, what the CFPB tried to do in promulgating some of the financial payment apps under its supervisory power with its larger participant rulemaking, again, to kind of what you just were summarizing, that is clearly expressly authorized by Congress. It's given the CFPB this authority to promulgate rulemaking in order to allow the agency to evolve with industry. And I think that the other side of this is a lot of those enforcement and a lot of those rulemaking efforts were not aimed at traditional banking industries, but these new market entrants who thought that they weren't subject to the law. And so that's kind of, I think, a great example of how regulatory power and oversight can actually even the playing field between industry actors. But to kind of what the next 10 years are, we are seeing people's life savings depleted by fraud. And it's a night.
And I take it what you're referring to, I completely agree with you, scams. I think I did a recording yesterday of another podcast show with people from Aspen Institute that have created this white paper, fabulous piece of work on the need for our government at the very top to develop a policy to eliminate these scams that are occurring. Many of them are being launched from overseas, and they're in countries that are hostile to the United States. I think I heard they mentioned to me that something like $200 billion was scammed from individuals and companies through a wide variety of scams. A lot of them are somehow tied in with crypto. And, anyway, I'll let you, sorry to interrupt you on that, but we definitely have reached common ground on that one.
I mean, I think that when I say fraud or scams, what I'm really focusing on is the consumer experience. What does the person feel like has happened to them? And they've had their money stolen. That's what it feels like. And, I think also to your point is that this is proliferating. And this is, again, another example of a place where people are not going to be able to self-protect against this. Young people, old people, highly educated people, highly savvy people, tech savvy, tech illiterate, everyone is susceptible to this. And with, I think, digital payment apps in particular, it is proliferating under Director Chopra's CFPB note. So I think that what I would point out with fraud or scams is that it happens under every administration. It's administration agnostic. And I think, Alan, this is where I would also really push back on the importance of financial protection as this proxy for the democratic governance, which is, consumers lost almost $390 million in 2024 alone to fraud perpetrated via digital payment apps. I am not saying this is exclusively the digital payment app's fault, or that they should be held responsible, or that they should necessarily be the ones to make consumers whole. But the CFPB attempted a rulemaking that would have brought these companies that run payment apps under supervision from the CFPB. And going back to your earlier question about, what I think the most important impact out of the CFPB is, your second place was a lot of the mortgage origination rules, which I completely agree. But I think my second place is actually this really robust supervisory fact possibility. And one of the reasons that I think that that's my second place ranking is because this possibility to monitor for harm or risk of harm before things go catastrophically wrong is really critical. And I think that pulling payment apps, again, to your point about innovation, pulling payment apps under supervision in a lot of ways is a great example of the regulatory powers of the CFPB evening the playing field between traditional bank industry and then these new market entrants. But, the United States Congress voted 219 to 211 to disapprove of that rulemaking. And there's been no new legislation put forth by Congress that disapproved the rule, nor a rulemaking from the CFPB, which is more focused on, finalizing its Regulation B rulemaking to now protect those $390 million stolen from Americans in 2024 alone. So I think that that's a great example of how regulatory authority can both even the playing field and can evolve with a changing marketplace of risks. And in a lot of ways is actually making things more stable. But I think that this act from United States Congress of disapproving that rule is completely inconsistent with the needs of its constituents. And I think that that's betrayed by the fact that since that disapproval on April 9th, 2025, there's been no legislation put forward by that same Congress that disapproved the rule, nor has there been a rulemaking put forth by CFPB. So, this notion that it's trying to correct for regulatory overreach just isn't borne out even by, last year.
Okay. I've got one final question for you on your article, and then we'll wrap it up. You say that consumer advocates should build broader coalitions with other movements. What might that look like in practice, and how could it influence the direction of financial regulation?
Yeah, I think that's a great. I included that in the article maybe as a great opportunity for future scholarship, but I think that what I'm trying to center there is that consumer financial protection is ultimately has become this bellwether for our government's antipathy towards its constituents. And I have heard loud and clear, Alan, your distaste for the way that Director Chopra ran the CFPB in this interview today. But I think that what we also see right now is an opportunity to take a step back and recognize that, if we're going to Asita Nwanevu's, pillars of democracy, that there is a lot of scholarship about, as Daughter White alluded to, whose interests are being elevated, to whom is the government being responsive. And so what I'm trying to center with this suggestion here is that, for example, the final rulemaking for Regulation B does not seem at all to reflect the 64,000 comments that the rulemaking got from the public. There's no changes from the proposed rulemaking, but is this, kind of specific nuance of the final rule of Regulation B the end all be all of organizing right now? Or is this just another step of our government completely disregarding the individuals and constituents it's either meant to protect in the case of the CFPB or it's meant to represent in the case of Congress and the President of the United States.
Okay. I get your point. And Amelia, I want to thank you very much for joining us today and for engaging what I think has been a very thoughtful and spirited discussion. Your article raises significant questions about the future of consumer financial regulation, including the role or appropriate role of the CFPB, the balance between federal and state enforcement, and the broader policy debates surrounding consumer protection in the U.S. And these debates are likely to continue as policymakers react to the direction that's set by prior leadership and they chart a new course. So my thanks to you. Good luck with your article. I also want to thank our listeners for tuning in for today's episode of our podcast show. And please, if you enjoyed our show today, please express your views on the whatever platform you may have used. With that, I hope everybody enjoys the remainder of their day.